Still paying tax on your 401k after 65? Here's the part nobody at the IRS is going to tell you. That RMD bill you're staring at right now, it isn't fixed. It isn't final. In some cases, it can legally be reduced before it ever hits your account. Nobody at your custodian is going to call and mention this. It's not a loophole. It's been sitting in the tax code for years, completely legal, and retirees who catch it are already using it. They just never told you it existed. Today I'm going to show you exactly how this works, what it's worth, and the specific move that gets it done. Stay with me. The part that actually changes your number is coming up next. I'm not exaggerating when I say this catches good savers off guard. I sat across the table recently from a couple in their late 60s, looking at a number the IRS had been quietly building inside their traditional 401k since the day they opened it. Not their balance, not their growth, their own future tax bill. Every dollar they contributed to that 401k was pre-tax. Every dollar of growth was deferred. And deferred doesn't mean forgiven, it means delayed, until the year they turn 73, whether they're ready or not. Nobody handed them a warning label when they opened that account 30 years ago. No accountant flagged it. No HR department mentioned it either. And by the time most people notice, it's already stacking on top of Social Security, pushing their bracket higher, and quietly raising their Medicare premiums too. Here's who this actually matters to. If you have $500,000 or more sitting in a traditional 401k or IRA, you're exactly the person this bill was written for. Not because you did anything wrong, as because the rules were written that way from day one, and almost nobody explains it before it's too late to plan around it. The bill you're about to see isn't a guess. It's the exact math already sitting inside your own statement, whether anyone's pointed it out to you yet or not. Stay with me because the part that changes it is coming up next. Let me show you the exact tax bill nobody ever warned you about. It's called the Required Minimum Distribution, the RMD, and it isn't a suggestion. It's a federal mandate. Starting at age 73, the IRS tells you how much you must withdraw from your traditional 401k or IRA every single year, whether you need the money or not, whether it's a good year for your tax bracket or not. They decide the amount, they decide the schedule, and every dollar that comes out gets stacked on top of whatever else you're earning that year. Social Security, pension income, investment income, and taxed as ordinary income at your highest marginal rate. Here's what that looks like in real numbers. Say you have $1 million in a traditional IRA at 73. Your first required withdrawal is roughly $38,000, and it only grows from there. That lands on top of your Social Security and pension, and your bracket climbs. Your Medicare premiums rise, up to 85% of your Social Security becomes taxable, and the IRMAA surcharge, that stands for Income-Related Monthly Adjustment Amount, quietly drains your Medicare Part B and Part D premiums every month. Here's the part almost nobody explains about that Medicare number. It isn't a gradual slope, it's a cliff. IRMAA works in hard income brackets, and if your total income lands even $1 over a threshold, you don't pay a little more on that dollar. You pay the entire higher premium for that whole bracket, for both you and your spouse, for the full year. Cross from one tier into the next because an RMD pushed you over by a single dollar, and a couple can see their combined Medicare Part B and Part D premiums jump by several $1,000s a year, not because they earned meaningfully more, but because they landed on the wrong side of a line they never saw coming. And it's based on your income from 2 years earlier, so by the time you feel it, the RMD that caused it already happened long ago. The RMD freight train is coming. Are you on the tracks? If that question landed for you, if you're doing the math in your head right now and realizing your own 401k is carrying this same silent bill, hit subscribe. I post a new strategy every week, and what's coming next builds directly on this one. That percentage climbs every year you're alive, so the bill keeps growing. If you have $500,000 or more in a qualified account, you're standing where thousands of retirees stood before they understood what deferred really meant. Here's the part nobody tells you, and it's the entire reason I made this video. Between now and 73, there is a window. The single most valuable window in retirement planning where you still control your income and your bracket before the IRS shows up demanding their share. The retirees who catch this window don't do anything exotic. They make 3 deliberate moves. Let me walk you through all 3. Move 1. The Pre-RMD Roth ladder. This is the foundation move. It works because of one simple truth. The tax rate you pay today is almost always lower than the rate the RMD will force on you at 73. Every year between now and 73, you convert a portion of your IRA into a Roth. You pay the tax now at a rate you control and remove that money from the mandatory withdrawal system for good. No RMDs on a Roth. No forced income. That money grows tax-free and comes out tax-free for life. Retirees who act between 62 and 70 can often convert $50,000 to $80,000 a year in a 22 to 25% tax bracket, far cheaper than the 32% or higher they'd pay a decade later, forced. Converting on your schedule, at your rate, isn't just smart. It's the difference between a retirement that works for you and a retirement that works for the government. Move 2. The protected, tax-free container. The Roth ladder is powerful, but it has a ceiling. The IRS limits how much you can convert in a given year before the tax cost climbs too high. So where does the rest of the money go? The part you can't fit into a Roth without pushing yourself into a much higher bracket than you intended. The answer, for many retirees, is a properly structured Indexed Universal Life Policy, an IUL, a protected tax-free container, built under IRS Tax Code, Section 7702. If the market goes up, you make more money. If the market goes down, you don't lose any money from that. And the cash value inside it is what's known as a Tier 1 asset, the same category banks use for cash and U.S. Treasury bonds. Banks even have a name for it, BOLI, Bank-Owned Life Insurance. If it's safe enough for a bank's own balance sheet, it deserves a serious look on yours. There's a floor built into the design. You're not chasing the best year the market can offer. You're refusing to ever have a worst one, and over a 20 or 30-year retirement, avoiding the bad years often matters more than capturing every point of the good ones. And when you access that money through policy loans on your own schedule, the IRS does not classify those loans as taxable income. No 1099, no tax event, no bracket impact, no RMD requirement of any kind. Unlike a traditional 401k or IRA, this money never shows up to inflate your Medicare premiums or push more of your Social Security into taxable territory the way an RMD does. Protect your principal before the IRS picks it apart. That's the entire philosophy behind this second move, and it's why so many retirees add it alongside the Roth ladder rather than instead of it. Move 3. Standard Deduction Arbitrage. This is the move that surprises people most because it sounds almost too simple to be real, and because almost nobody realizes it's sitting there, unclaimed, every single year. Every year, you and your spouse get a standard deduction, roughly the first $30,000 of income tax-free automatically. In the years before your RMDs begin, you can intentionally realize income up to the top of that deduction, filling a bracket the IRS is otherwise going to force you to fill later at a much higher rate. Think of it as filling the cheap seats before the IRS fills the expensive ones for you. Most pre-retirees ignore this entirely, letting that bracket sit unclaimed. For a retired couple with modest other income, filling it deliberately can mean recognizing $20,000 to $30,000 in a single year at a zero or near zero rate. Money that would otherwise come out at 22% or higher once RMDs and Social Security are both running. Let me show you what all three moves look like together for one retired couple. A couple in Arizona, both 66, sat across from us with just over $1 million combined in traditional retirement accounts. No pension, Social Security not yet claimed. Their previous advisor had never mentioned the window waiting for them 3 years down the road. Over the following 6 years, they used all three moves: a Roth conversion some years, a contribution into the protected tax-free container other years, standard deduction arbitrage whenever their income dipped low enough. Nothing complicated in any single year. Small, deliberate moves repeated consistently. By the time their first RMD arrived, their projected withdrawal had dropped from roughly $52,000 a year to under $18,000. Their Medicare premiums stayed at the base rate, their Social Security remained mostly tax-free, and the surprise tax bill that blindsided their neighbors that same year never touched them at all. Here's your mirror moment. If you have $500,000 or more sitting in a traditional 401k or IRA right now, and nobody has walked you through the pre-RMD window, the protected tax-free container, or standard deduction arbitrage, you're standing exactly where that couple stood 3 years before their first RMD arrived. Not because you made a mistake, because nobody ever warned you. The 3 moves you just saw aren't loopholes. They're the exact tools the tax code already makes available to anyone who acts before the window closes. Control the decision now, or let the IRS control it for you later, on a schedule you never chose. Below this video is a link. Book a private one-on-one strategy session. We'll sit down together, look at your specific numbers, your balance, your projected RMDs, your bracket at 73, and show you exactly how much of that future bill can legally be reduced before the window closes. You spent decades building this account dollar by dollar. Spend 30 minutes protecting it. Rescue, reclaim, retire richer.